Hi friends, it's Jasmine, your Vancouver, Washington Realtor extraordinaire. And if you're looking at the Pacific Northwest, wondering if the BRRRR method still makes sense here, I've got some real talk for you. I work with a lot of investors, both local and out of state, and this is one of the top questions I get. Is Vancouver still a good place to buy, rehab, rent, refinance, and repeat? Or has the ship already sailed? Before we get into the details, if you're actively looking for investment opportunities or even just exploring the idea of building a portfolio in Southwest Washington, I'd love to be your resource. You can call me, text me, email me, or fill out my buyer's questionnaire linked down below. I'll get back to you with real numbers, neighborhood-specific guidance, and local contacts you can trust, including contractors, lenders, and property managers who actually show up. In this video, we're diving into what BRRRR investing looks like in Vancouver as we head deeper into 2025. We'll break down what's changed in this market, what kind of properties still make sense for this strategy, where I'm seeing the best opportunities, and how smart investors are adapting their approach to keep making it work. And don't forget, if you want support analyzing deals or finding off-market opportunities, my info is below. I'm all about helping investors make strategic, sustainable choices, and I'm excited to show you what's still possible right here in Clark County. Let's get into it. Let's start with the foundation of the BRRRR strategy, because if you're watching this video, you probably already know the basics. But just to ground us, BRRRR stands for buy, rehab, rent, refinance, repeat. The goal is to recycle your capital, buy a distressed or undervalued property, fix it up to force appreciation, rent it out to create cash flow, then refinance to pull out most or all of your initial investment so you can repeat the cycle. This method exploded in popularity over the last decade because it allowed investors to scale faster without tying up large sums of money in each deal. And in a market like Vancouver, Washington, where prices were much more accessible, this strategy was golden. But here in 2025, the landscape has shifted. First off, the buy step is much harder now. Inventory is tight. We're still hovering around 2 to 2.5 months of supply, according to the latest RMLS data, and distressed properties are no longer sitting on the MLS waiting for someone to scoop them up. Most of the truly under-market deals never even hit the open market. They're going to flippers with cash in hand, wholesalers with deep networks, or local agents like me who know which homes are quietly available off-market. Next up, rehab costs. Materials like lumber and drywall have stabilized slightly since the 2021 to 2022 surge, but overall, renovation budgets are still much higher than pre-pandemic norms. Labor costs are also way up, partly due to inflation, partly because of an ongoing shortage of skilled tradespeople in the Pacific Northwest. If you don't already have a solid contractor relationship in place, be prepared to pay more and wait longer. And that brings us to the R for refinance, which is where many BRRRR investors are hitting a wall. In 2025, mortgage rates are holding around 6.5% to 6.8%. That's lower than the 7.5% we saw last fall, but it's still high enough to squeeze your cash flow and limit how much equity you can pull out. Unless you've created significant value through the rehab or bought the property far below comps, the numbers may not work like they used to. You'll also want to factor in stricter lending requirements. Lenders today are scrutinizing investment property appraisals more closely, and cash-out refis aren't as aggressive as they were in years past. Some investors are pivoting to DSCR loans or local credit unions that offer portfolio lending, but those come with higher fees or tighter terms, so it's not one size fits all. And finally, the biggest shift of all, you have to be more strategic than ever. Gone are the days of casually picking up a fixer and trusting the market to carry your investment. In today's climate, successful BRRRR investing in Vancouver requires a sharper eye, faster decision-making, and deep local knowledge. You've got to know which neighborhoods are poised for growth, where you can still add meaningful value, and how to structure your deal to leave room for profit. But if you can get those pieces right, there's still a huge upside. You just can't use yesterday's playbook. If you're still serious about pulling off a BRRRR strategy in Vancouver this year, the next question is, where should you look? And just as importantly, what kind of properties actually make sense for this strategy in 2025? Let's start with neighborhoods. In my boots-on-the-ground experience, East Hazeldale and Fourth Plain Corridor are two areas investors are quietly paying attention to. You're still able to find older homes here, think 1950s to 1970s builds, that haven't been updated in decades. The bones are solid, but the cosmetic work hasn't been touched in 30 years. That's exactly the kind of value play a BRRRR investor looks for. Another area with potential, Central Orchards. It's sandwiched between more developed zones, but still has pockets of single-family homes where long-term homeowners are starting to downsize. These off-market deals or estate sales can be gold mines if you got the cash or connections to move fast. And if you're really playing the long game, parts of Minnehaha and Westfield are worth exploring. There's less buyer competition here and rents are slowly creeping upwards. You won't get the flashiest comps, but you can get better cash-on-cash returns than more established neighborhoods like Fisher's Landing, especially if you plan to hold for 7 to 10 years and ride the appreciation curve. Now, as for what types of properties to target, here's what I'm advising my investor clients to look for in 2025. Homes under 1,500 square feet with 3 beds, 1 to 2 baths, small enough to rehab quickly, but big enough to attract long-term renters. Properties with ADU potential, either detached garages, basements, or oversized lots with alley access. Adding an accessory dwelling unit can double your rental income or provide a built-in value add. Outdated but functional layouts, you don't want homes that need full reconfiguration. Cosmetic rehab, light kitchen and bath upgrades, and paint flooring projects are still the best bang for your buck. Zoned R18 or higher in city limits. This opens up the possibility of future multifamily use, which is a quiet way some BRRRR investors are hedging against future zoning reforms. One tip, don't sleep on duplexes and triplexes. Multifamily BRRRR opportunities in Vancouver are rare but valuable, especially with Clark County's rising rent caps and the lack of new multifamily inventory. If you can grab one and rehab it without displacing long-term tenants, you're in a strong position. Just keep in mind, Vancouver isn't cheap anymore. You're not likely to find a sub $300K fixer-upper unless it's distressed and off-market. But if you can get into $400,000 to $500,000 range and force enough appreciation during rehab to refinance above 70% LTV, the model still works, especially when you factor in rising rental rates. Let's talk about rental demand, because BRRRR doesn't work if you can't rent out the property quickly and at a price that makes the numbers pencil. And in 2025, Vancouver's rental market is showing some very promising signs, but also some new challenges investors need to navigate. Across Clark County, rents have steadily increased year over year, with 2 to 3 bedroom single-family homes in Vancouver now averaging $2,200 to $2,600 a month, depending on neighborhood and amenities. In more desirable school zones like Philida, parts of Orchards, and Camas, the number pushes even higher, and demand for pet-friendly units with fenced yards, modern kitchens, and updated bathrooms remains incredibly strong. What's fueling this? 2 things. Limited inventory of new rental stock. Vancouver's population continues to grow, especially with folks relocating from higher-priced markets like Portland, Seattle, and even the Bay Area. But we haven't seen a matching boom in rental construction. That squeeze is keeping demand up, especially for well-maintained homes in move-in condition. Tenant preference has shifted towards small homes. Post-pandemic renters are done with apartment living. They want privacy, space to work from home, and safe neighborhoods. This makes your BRRRR renovated single-family rental a premium product, even if it's modest in size. That said, tenants in 2025 are also savvier. They're comparison shopping, reading reviews, and looking for energy-efficient features. If your rental has older windows, zero landscaping, or outdated appliances, it'll sit longer or rent for less. Smart upgrades like LVP flooring, a neutral color scheme, stainless appliances, and in-unit laundry will absolutely help you charge top-tier rent and reduce vacancy. Cash flow, of course, depends on your acquisition price and how you structure your financing post-refi. But if you're picking up a home in the $425,000 to $475,000 range, doing a $40K rehab, and refinancing at 75% LTV with today's investor rates, hovering around 7.25 to 7.5%, you can still net $400 to $700 a month in positive cash flow, assuming you self-manage or use a low-cost property manager. One final thing I always remind investors, longer vacancies kill returns. That's why marketing and tenant placement strategies matter just as much as the rehab. Good photos, clear criteria, competitive pricing, all of that plays into your success. Financing has always been one of the trickiest pieces of the BRRRR strategy, and in 2025, that's still true. Between rising rates, tighter lending criteria, and changing investor loan products, it's more important than ever to go in with a plan. First, let's talk acquisition financing. If you're buying a distressed property that won't qualify for traditional lending, you're probably looking at hard money or private lending. Rates for hard money in the Vancouver area are ranging between 9% to 12% with 1 to 2 points, depending on your experience, down payment, and the project scope. These are short-term loans, usually 6 to 12 months, meant to get you through the rehab phase. Now, some investors use portfolio loans from local credit unions or community banks. If the property is livable, this can be a better route with lower rates, often in the 7 to 8% range, and no balloon payment. But you'll likely need 20 to 25% down, and the underwriting will be based more on your global income picture. Next comes the refinance, the critical R that determines how much capital you can recycle. This is where appraisals really matter. You want to refinance based on the after repair value, ARV, not the original purchase price. That's why it's crucial to document your upgrades, use finish levels that boost value, and work with a lender who understands BRRRR. In 2025, DSCR, debt service coverage ratio loans, are still one of the most common ways to refinance a BRRRR property. These loans don't rely on your personal income. Instead, they use the rental income of the property to qualify. Most lenders want a DSCR of at least 1.2, meaning your rental income needs to exceed your projected mortgage payment by 20%. Interest rates for the DSCR loans are hovering between 7.25% and 7.75%, with 30-year fixed options and interest-only terms available in some cases. Expect to put 20 to 25% down or to refinance at 75% loan-to-value ratio. There are some options for 80% LTV, but they usually come with higher rates and stricter qualifications. If your goal is to recycle your capital and move on to the next project, this is where tight budgeting, a strategic rehab, and a realistic appraisal come into play. I always suggest working backwards, know what the ARV needs to be to make the numbers work, and don't overspend on cosmetic upgrades that won't boost appraisal value. And remember, not all lenders are BRRRR friendly. I've seen deals fall apart because someone used a lender who didn't understand investor timelines or required a 6-month seasoning period before refinancing. That's why having the right team in place matters just as much as finding the right property. If you've been in the investing game for a while, you already know real estate is a team sport. And when it comes to executing a successful BRRRR in a market like Vancouver, Washington, who you work with can make or break your return. Let's start with your realtor, and not just because I am one. You need someone who understands investment properties and the local market. That means someone who knows how to find undervalued homes with value add potential, understands what makes a deal pencil out, and can flag red flags like zoning issues, utility complications, or unpermitted work before you're too deep. Next, your contractor. I can't stress this enough. The quality and speed of your rehab determines your ability to refinance and cash flow. In 2025, good contractors in Clark County are busy and expensive. You need one who's reliable, licensed, insured, and ideally experienced in working with investors. Someone who knows how to meet basic rental standards without over-improving. Then there's your lender. If you're BRRRRing, you don't want just any lender. You want one who knows the strategy. That includes understanding hard money loans, DSCR products, cash out refis, and how to time things so you're not stuck paying a higher interest loan longer than you planned. I work closely with lenders who specialize in this kind of financing, and having the right partner here can save you tens of thousands over the course of a project. Don't forget your property manager. Even if you plan to self-manage initially, a good manager can give you insight into rental demand, expected rents, what upgrades are worth it, and how to attract reliable tenants. And if your goal is to scale, you'll eventually want systems in place that don't rely solely on you. And finally, your title and insurance partners. You'll want a title company familiar with investor transactions and quick closes. And your insurance agent should understand what it takes to insure a property during renovation, how to switch to a landlord policy post-refi, and how to bundle for savings if you're scaling a portfolio. The biggest mistake I see newer investors make, trying to DIY everything or using residential-focused professionals who don't understand BRRRR. If you're serious about building long-term wealth through this strategy, surround yourself with a team that's done it before and can help you repeat the process again and again. When my investor clients work with me, I don't just help them find deals, I connect them with trusted vendors, review estimates, run cash flow models, and help them stay focused on the end goal, a cash flowing asset that they can refinance, repeat, and keep growing from. So after breaking down all of the pieces from the market conditions to the rehab math and team structure, the real question is BRRRR still a smart move here in Vancouver, Washington in 2025? Here's my honest take. It depends on your experience, your access to capital, and your willingness to adapt. The days of scooping up a $200,000 fixer, doing a quick cosmetic flip, and pulling out $100,000 in equity 6 months later, those days are mostly gone in this market. Inventory is tighter, competition is stronger, and you'll need to dig deeper for deals that actually pencil out. That said, if you're an experienced investor who understands how to identify opportunity beyond just price, BRRRR is still very much alive in Vancouver. You're going to need to be patient and persistent with deal sourcing, get strategic with your renovation scope, work closely with a lender who understands short-term and refi products, run conservative numbers and plan for delays or budget overages. But if you do all of that, you can absolutely still find under market properties, add value, refinance your money out, and scale your portfolio, especially in parts of Clark County like Hazeldale, Orchards, parts of Battleground, or even Ridgefield if you're early on a neighborhood. In fact, I'm working with investors right now who are closing BRRRR deals with 6 to 7% cap rates and seeing long-term appreciation layered in. They're not unicorn deals, they're just smartly structured, timed well, and backed by solid execution. If you're brand new to this strategy, I'd recommend starting with a hybrid approach. Maybe buying a house hack or small multifamily and living in it for a bit while rehabbing. That gives you time to learn the local market, vet contractors, and position yourself better for second or third deal. So yes, BRRRR can still work here in 2025, but it's not a get-rich-quick plan. It's a long-term strategy that requires preparation, partnerships, and patience. And if you want a local realtor who can help you evaluate deals, build your team, and stay focused on the repeat part of BRRRR, that's exactly what I do. So if BRRRR investing has been on your radar and you're still trying to figure out if it's possible in a market like Vancouver, I hope this video gave you a realistic and encouraging look at what it takes in 2025. Here's the truth. It's not easy, but it is doable, and the investors who are still succeeding are the ones who are committed to doing it right. They're running smart numbers, building strong local teams, and treating real estate like the long game it is. If you're serious about investing in Clark County and you want someone on your side who knows the neighborhoods, knows the off-market tactics, and can help you avoid the mistakes that kill a BRRRR deal before it starts, reach out. I work with local and out-of-state investors, and I'd love to be your boots on the ground here in Southwest Washington. You can call me, you can email me, or you can fill out my buyer questionnaire linked below. It only takes a minute, and once I know your budget and goals, I'll start sending you curated properties that actually fit what you're looking for. And tell me in the comments, have you ever completed a BRRRR deal, or are you considering one for the first time? I'd love to hear your experience and your questions so I can keep creating content that helps you build real wealth through real estate. Thank you so much for watching, and I'll see you in the next video. Bye!